All right, today we're going to deconstruct a true giant, a company that's probably in every single one of our homes, Pidilite Industries. We're going to dive into an investment research note and really see what makes this company a financial fortress.
Okay, before we jump in, we have to get the legal stuff out of the way. Just so we're all clear, this explainer is based on a personal investment research note prepared solely for private use by Stressfree Investing. It is absolutely not financial advice, and it's not a solicitation to buy or sell anything. The author might even own shares in Pidilite, so remember, always do your own research, and please consult a SEBI-registered investment advisor before making any decisions. All right, let's get to it. So let me ask you a question. What if you could find a company whose business was, well, nearly unbreakable? And what if its balance sheet was built like an actual fortress? Well, according to this report, that's exactly what we're looking at with Pidilite. So first things first, let's talk about what makes Pidilite so incredibly special. We're going to start with its qualitative strength, or what investment folks call its unbreakable moat. Get this, over 70%. That is Fevicol's market share in woodworking adhesives. It's not just a product, it's the industry standard. It's the default. It's practically a monopoly. So how on earth do they do it? Well, the report says this moat is built on three massive pillars. First, the brand power. I mean, come on. In India, you don't ask for glue, you ask for Fevicol. It's that simple. Second, the switching costs are incredibly high. Think about it. Carpenters literally learn their trade using Fevicol. Switching to something else, that's a huge risk to their reputation and their work. And third, a monster of a distribution network. We're talking over 4,800 distributors getting their products into more than 18,000 towns. This is an ecosystem they've built for decades. It's just immense. Okay, so this story is amazing, right? But does it translate into the numbers? A great business should have a rock-solid balance sheet, and this is where we see that financial fortress in action. Zero. A big, fat zero. That's the company's debt-to-equity ratio. Pidilite has absolutely no debt. In a world full of economic ups and downs, being debt-free is a superpower. It's a huge strategic advantage. And what about efficiency? Check this out. A 31.1% return on capital employed. You know, to put that simply, for every 100 rupees the company puts into its business, it generates over 31 rupees in profit. That is just exceptional, top-tier value creation right there. And finally, for a quick financial health check, the report uses something called the Piotrowski F-score. Pidilite scores a 7 out of a possible 9. Anything over 7 is considered really, really strong. It's like getting an A on your financial report card. So yeah, the numbers definitely back up the story. But, and there's always a but, isn't there? Here's the big conflict in this whole investment story. This kind of quality is never cheap, and the report dives headfirst into what it calls the high price of excellence. And this right here, this is the classic investor's dilemma. On one hand, you've got that mind-blowing quality, that 31% ROCE. But on the other hand, look at the price, a price-to-earnings ratio of almost 56. The market knows this is a fantastic company, and boy, does it make you pay a premium for it. So what could go wrong when you're paying that much? The report flags three major risks. First, that premium valuation leaves absolutely zero room for error. One bad quarter, one piece of bad news, and the stock could get hit hard. Second, its raw materials, like VAM, are tied to volatile oil prices. A price spike could really squeeze their profits. And third, there's execution risk. They're jumping into the insanely competitive paints market. That's a tough battle to fight. So we've got a world-class business, a sky-high price, and some very real risks. Where does that leave us? What's the final verdict from the report? Is there actually an opportunity here? Let's find out. The analysis lays out three possible scenarios. In a worst case, or bear scenario, the price could drop to 980. The most likely, or base case, targets around 1560. But in a bull case, if things go really well, it could hit 2050. Now, here's the key takeaway. The potential upside is 2.6 times the potential downside. That's an interesting risk-reward setup. Because of that, the report's final verdict is to accumulate. Now, this doesn't mean go out and buy it all today, no. It suggests a patient strategy. Build a position slowly, gradually, over maybe 3 to 5 years, taking advantage of any price dips along the way. And here it is, the core reason for the accumulate rating. The stock has actually been underperforming lately, and that's caused its valuation to come down from its crazy highs. The opportunity isn't that it's cheap compared to the market, the opportunity is that it's cheap compared to itself historically. The report argues this has opened up a rare valuation window for long-term investors, something we haven't really seen since 2019.
The full report is in the description if you want to check it out. And hey, if you like this deep dive, make sure to like and subscribe. It really helps out. But most importantly, which stock should I look at next? Let me know in the comments. Signing off, this is stress-free investing for now. And if you like this report, I am sure you'll also like the report on atyl chemicals and other stock analyses in my playlist named Stock Specific Analysis. See you next time.